Hey boys, it's Kyle from the car. I know you usually record around this time. Are you seeing the same outage I'm seeing? Trying to log into my DraftKings profile. I'm trying to take the over on the Celtics preseason game tonight. It keeps flashing something about AWS. What's that? Another wicked screw up? This is the worst day. Mondays are sacred. I usually get a bloomin' onion, DoorDash to the house over in Revere. Comfort food for the working man, but I guess that ain't happening today. And my mother, she can't check her Ring doorbell for Amazon packages. Says she's got to use her eyes like it's 1998. What a nightmare. My kid's Pokemon Go won't go. My wife's Starbucks app won't load. So now she's got to walk and talk to people. I told her, just stay strong, babe. We'll get through this. Anyway, hey, producer Ben, don't go blaming this outage for your lazy ass, all right? Don't tell me, oh, Kyle couldn't upload the episode because of AW. Kyle's been carrying your ass since the Obama administration. All right, boys, hang tough. Sayonara from the car.
From Mostly Media, it's Mostly Growth. Go-to-market strategist Kyle Poyer and CFO CJ Gustafson share smart takes on growing revenue and running a company. Pricing, unit economics, AI, leadership, candid insights for CEOs, CFOs, and CROs, or anyone else aspiring to climb to the C-suite. This is Mostly Growth.
So CJ, like a good podcaster, you were out in LA last week. How was the flight back?
Well, let me start with plain Wi-Fi, okay? I got the cursed email 1 hour before boarding that the Wi-Fi probably wasn't going to work for this flight. So
They gave you a heads up in advance the Wi-Fi probably wouldn't work. I've never seen that.
I would rather just not go at that point.
Like, is it too late to cancel?
Yeah, had to raw dog a 5.5 hour flight just there with my thoughts.
Turn it on to just watch the plane slowly travel across the country. You just stare at it.
I finally learned where Mississippi was in the map. But what really pissed me off is when I got off, I finally got Wi-Fi, and I'm just doom scrolling through Twitter in the Uber. And this guy, he said, just closed a $7,000 deal on a flight back from SF. I'm only 19. F Netflix, sales calls are my entertainment. Dude, there is no way the Wi-Fi on any flight is strong enough to hold a video call, let alone be making a sale over the Wi-Fi. This really put me over the edge that I couldn't get reliable Wi-Fi.
And some 19-year-olds on sales calls.
The trip overall, you know, I met a famous producer out there.
You met me?
Ben the Benevolent?
I met Ben the Benevolent, a producer who lives in Hollywood.
I live in the real Hollywood, too.
Yeah, it was planes, trains, and automobiles once I got there, too.
And they're in construction mode for the Olympics, right?
Oh, is that what was going on?
All those Olympics that Boston was going to hold, and then we backed out.
Yeah, or we didn't like grease the right palm. Somebody probably got paid off. But overall, LA has the most frustrating traffic scene. So me and Ben had a dinner at Nobu.
Not to brag or anything.
Not to brag or anything, but I took 25 of my closest friends to Nobu. Thanks for the sponsors who paid for it. But like I should have left at like noon to get there by 6:30. It was brutal. Yeah, Ben came to ensure that they weren't sad dinner pictures.
I want to see that calamari. Is it limp? Is it fresh fried? How's that looking?
Listen, I make it a note to not take a picture of food at these things because it never looks good. It never is going to look like perfectly plated or anything like that. Like the lighting's going to be weird. Those food photographers get paid a lot of money for a reason.
Yeah, like whoever does the shots for the Jimmy John's Italian subs.
Exactly.
Because it's very different when you get like a wet salami sandwich. But I digress. Explain to me why your city is a hellscape for transportation.
Dude, I'm so glad. I'm so glad that everything is built to this moment for me to finally talk. I will try and keep this brief because I could go on for eons, but I do have to start like way, way back. Los Angeles is spread the hell out, and I think it's like regionally, I don't know, it's bigger than probably bigger than Connecticut where you are, CJ. But it's also been through like so many different phases of existence. Like you think of LA as being this like Hollywood institution, but LA actually way before that, the original settlers here established it. It also then became a like agricultural place with like a lot of like orange groves and like farming. There was an oil boom in like the late 1800s. It was beneficiary of the railroad boom, as we talked about in I think one of the last couple of podcasts. And that was all of that was before it became Hollywood before it had this like influx of, all of the movie talent in the world coming to one place. And so because of that, partially because of the railroad boom, it was really spread out where Henry Huntington built this vast transit system that at one point in the world, LA had like the most expansive transit system. Just watch Who Framed Roger Rabbit to find out more about that. But because of that, it was like a real estate play where he would build these lines to nowhere, essentially, to empty land, and then he would sell the land. And so that's one of the reasons that LA is so spread out is because you could just take a train, because the train was there before that the houses were there.
So you're saying they're the original OpenAI?
The original OpenAI, yes, but without the servers that fall off of the wall. Traffic is absolutely dreadful because you've also got, because this real estate kind of boom happened in tandem with the railroads, you had these little pockets of communities that would sprout up that were like their own independent cities. But then, as time has gone on, you have these different centers, but then you have these people that are working in different centers. Like you're working in Century City, but you may live in Pasadena, which is like, tens of miles apart. And for example, CJ decided to go from Marina Del Rey all the way to West Hollywood, which I compared this later on in Google Maps, that if you're familiar with New York, it's like staying in Coney Island and going to an event in the Village. Like that's how long it takes to get from that sort of thing. If you figure like I don't know New York too well, but like if you're in New York, like, and you're staying in Coney Island, like that's your like base of operations, that's a big trek to go like to the Village sort of thing. So I think there's some context like that you need, like I tried to give, but then also it's just like over time, it's been terrible. Last thing I'll say, there's no region that is building more transit than Los Angeles right now in the US. So there is like an effort being made to fix it. But as you can probably tell, it's a very, very, very big lift to be able to solve.
Well, you should tell them to install Wi-Fi.
We're going to need to cut that.
We'll clip it down.
Nothing will come out of that. You realize you're talking to the editor of the podcast right now.
I told you he's a dictator. All right, Ben, what's our first topic for today?
Yeah, first up, we have got the rise of title deflation and the decline of the middle managers. Bye-bye, middle managers.
So CJ, you suggested this title. Are you changing your title from, founder and chief executive to writer?
No, I've changed it to founding BDR.
Even better.
That seems to be a trend. You can just take founding and put it next to any title. And suddenly, like, you're not C-suite, but there is a certain ring to it. And I'm seeing this all over LinkedIn. Founding marketer, founding account executive, that seems to be everywhere. Founding finance, or not put anything next to it. It just says finance. So like if you look at somebody from Cursor, they'll just say finance or OpenAI.
Oh yeah, everyone in OpenAI has the most generic, vague title I've ever seen.
Yeah. So I guess it's two things. One is like, what is the rise of this founding title? And two, are we actually seeing title deflation amongst people who would previously take jobs and be considered either a VP or C-suite? What's your take?
Well, this reminds me of what we did in venture, right? We'd have these like 23-year-old associates who were brand new to the industry, but we wouldn't want them to have like a generic sounding title externally when they were reaching out, essentially like founding BDRs to founders. And so we would just have them as like investments at or investor at, and just go really generic.
I remember that was a thing in consulting. So you see like some of my fellow first year associates, like, and we weren't really consultants. We were like glorified coffee getters and like make that shape over there red. We didn't really consult on anything because we'd never been in management before. But a lot of them would just write consultant at PwC. It's like, dude, like, what are you consulting on, just to use that?
And there's like tens and tens of thousands of employees at PwC. It's like, yeah, what is this? I don't mind the titles like founding BDR, founding AE, founding marketer. It implies, it just gives it a little bit more cachet when realistically you have no team and you're doing everything yourself. It also gives a little bit of permission if it doesn't work out. Well, you could say, hey, look, I was the first one. They didn't have a function. I had to do everything from scratch. And so it brings in talent that kind of likes that idea of getting in early, but also gives you an out if you don't last.
I think that's a great point, because when I'm thinking about taking a job, or if today I was assessing, hey, do I want to join this company at seed stage or series A? I look at it like, hey, do I have enough runway here to build something and have a story for minimally 18 months to say I tried it? And I think to your point, Kyle, saying founding next to the title, it does de-risk that. Like, hey, I'm obviously taking a bit of a swing here, joining being the first person. And for the next role, you can say, I can build on top of that. The second component to this, though, is like, if you analyze what you can give somebody to keep them around as an employee, you can give them more money. You can give them more like at bats and experience, like expose them to stuff that won't always show up on LinkedIn, though. Or you can give them a title. And so you have these three levers to play with. I find it fascinating that founders are really keeping that third lever close to their chest and not wanting to call somebody a certain title, which I don't know if to you that comes across as like, oh, well, that's because we're going to bring in that person over you and level you later once we do go meteoric and get to $1 billion, or if it's like just a motivation thing where we want to promote you later on, but if we give it to you now, then you won't be as happy.
I mean, I saw that so many times in venture where a company would bring in a marketing leader who was more like a head of marketing or director of marketing, but they'd get that VP of marketing or maybe CMO title. This would be like a $1 million ARR company. And so a few years later, when they were at 10 million, they'd want to level over that person. But if they had given them this fancy title, it was like impossible. So it would be like VP of marketing, and then there's an SVP of marketing, and then there's an EVP of marketing, and you have this like ramping up of title inflation. And I think founders got the memo. Let's just nip that in the bud early so we don't run into problems later on.
There's one software company I was at, and I joined at it probably like 300 million. We got it to $1 billion. But there was this one guy, and he was the third sales hire ever. Now, when I joined around 300 million in ARR, we probably had like over 100 salespeople now. And by the time I left, we had over 400 salespeople there. And he had joined as VP of sales. You flash forward, he's been there for 12 years now. He's now like the VP of like 3 streets in Boston, pretty much. Like he's an area territory manager essentially, but you can't rip away the VP title from this guy. So now you have this weird org chart where like a VP is reporting to a senior director, who's then reporting to a VP, who's then reporting to an SVP, and then the CRO, and you end up with this bizarre looking org chart.
The thing that I've been focused on lately, so we're moving away from like these hierarchical titles, right? Of like SVP and VP and so on, and towards these generic titles like finance at X. And what I'm also noticing is that there's like a real decline of the middle manager, right? The manager, senior manager, director. We almost don't seem to, there's like a dirty word there. If you're seen as a middle manager, companies don't think that you actually do anything. And so everyone seems to be having you on the chopping block. So it might be better off to just have that generic title and not come across as a middle manager.
I was talking to Pedro, the CEO from Brex, for a piece that I wrote on them. And he was saying that when they went through a time of restructuring, that's exactly what they went for. They cut the fat in middle management. And he had a quote that really stuck with me. He said, well, you gotta have quote unquote managers who are still ICs and know their domain really well. Like if you looked at Johnny Ive, who designed the iPhone, he would never say, I'm managing the designers who are designing the iPhone. He would say, I'm a part of the team who's designing the iPhone. And I think that's a huge difference. If it's a middle manager, quote unquote, who's managing people, but also still hands on the wheel, still day to day can jump in and do stuff, that's a fundamentally different level of management and level of contributions, I think, than the one that I have in my mind. Like the person who's just like, hey, can you send me an update so I can change 3 words and then send the update up the flagpole?
Yeah, everyone seems to want managers to be ICs and great managers these days. The Economist had a great article on this called Bonfire of the Middle Managers. They pointed to data that Google said they cut 35% of their managers who oversaw teams of fewer than 3. Fiverr, the freelancing marketplace, middle managers as well. Meta's founder and CEO Mark Zuckerberg has been complaining about managers managing managers for the last couple of years. And then when they looked at earnings calls across the S&P, they found that reducing management layers was mentioned 98 times so far this year, which is twice as often as it was mentioned all across 2022.
I'm so torn on this though, because like if Meta announces that it's going to get rid of 2,000 middle managers, watch, their stock price will go up. But if you're a company that's sub 10 billion in market cap and you announce that you're cutting a huge swath of people and say it's middle managers, I actually guarantee your stock price will, this is not an investing show. My lawyers tell me to say that your stock price will probably go down. And so it's fascinating that once you reach a certain scale and you announce layoffs, like Microsoft says they're going to cut 5% of their sales force, the stock price goes up because people look at that as a good thing. But under a certain kind of threshold or size, it actually is looked at negatively.
I mean, the tech world loves to believe that we don't need managers, that you can just hire good people and let them run. I want to give a shout out to any middle managers listening here. I think honestly, this was the hardest role in my career. You're expected to keep doing everything you were doing, but now be responsible for someone else who's probably pretty junior. Like the middle managers aren't managing senior people. And so you get no training on how to manage these people. You have no real kind of authority with the absolute higher ups on the team. You're supposed to hand off work, but you can't really trust your team to do it well yet or to do it quickly. So a lot of times you have to do it yourself. This was a role that made me even think, do I actually want to be a manager at all?
Kyle, do you remember who the first person you ever managed was?
I do, but in consulting, you kind of manage like people on a project and as opposed to like a company. So I know both like the first person I managed in consulting and the first actual person I managed.
Yeah.
I like, if you think about this, CJ, like when did you learn how to use Excel?
Really, really use Excel well and be really good at it is when I went into the private equity world, which was 2 years after graduating. But like I started to dabble in it in consulting when I got my first job out of college. But honestly, I probably feel bad for whoever was managing me and like, oh, he's actually not that great at this.
Well, yeah. So your first job, you had no idea how to use it. You could use like the basic functions. If you had a good manager, they probably taught you some stuff.
Yeah.
But like how to write an email, how to interview a customer, how to make a slide, how to behave in a meeting, like all of those things you either learn through like osmosis from watching someone good, or you learn because you have a manager that actually takes the time to help you out when they have so much other stuff on their plate.
Yeah, and I think after managing people, that's where I started to appreciate the times when someone did take me aside and it wasn't just osmosis. It was them being like, hey, I remember I had this manager at PwC, Dasha, and she actually took me aside and gave me a critique of like how to write a good business email, which I think is very important, like to be client ready and not just do a brain dump on the page. And looking back, I'm like, oh, she had a bazillion things going on and she actually carved out 20 minutes to help me with something super tactical. So shout out to all the middle managers out there doing the Lord's work.
Yeah, seriously.
All right, Ben, what do we want to talk about next here?
Now, next up, you better be getting your wooden dowels, your coat hangers, maybe some marshmallows and chocolate, because Kyle, he's going to roast your pricing model.
I have never roasted a marshmallow using a coat hanger, but I have a...
I have, and I burned my hand badly.
Dude, it wasn't made out of metal? We gotta...
Blame the Boy Scouts of America. Listen, I was early in my camping experience. It's their fault.
Yeah, we got to unpack that. But CJ, I thought we could try something fun here. You up for it?
I'm game. How do I play?
All right. I want you to name a pricing model. Just start with any model, and I'll tell you what I honestly think about it.
Pick a card, any card. All right, Kyle. First, flat fee subscriptions.
Don't expect to make any money.
Feature-based pricing.
Welcome to bundle hell.
Seat-based pricing.
Isn't that a dinosaur?
Usage-based pricing.
CFOs hate it.
Preach. Hybrid pricing.
I'm going to need a PhD to figure out the cost of this thing.
Outcome-based pricing.
It's a pipe dream.
Poetic. Wow. This is good, Kyle. If you had to actually look at these though, Kyle, have you actually thought about like stack ranking them? Like which one's the best? Is there a best?
See, here's the thing. There is no such thing as a perfect pricing model. So I've talked to probably 36 founders and CEOs in the last couple of weeks about pricing. I did a pricing workshop at a conference lately, and then just have had a bunch of one-on-ones. These companies range from startups to mature companies. They have every pricing model imaginable. And like every single person seems to be somewhat embarrassed about their current pricing. And the thing is, like, I haven't met a company that has perfect pricing. There are problems with each and every one of these models. And I think that we've got to get over this idea that like there's a pricing model that exists out there that's going to be great for your product. And we've got to take what we're already doing and actually make it better.
But there's not one in here that's like democracy, like the best, worst form of government.
I mean, so flat fee pricing, feature-based pricing, seat-based pricing, usage-based, hybrid, and outcome-based pricing. I'd have to say hybrid pricing is probably the current democracy, like the best, worst option. It's that compromise, right? Where no one's actually that happy, but you're making money.
Which of these 6 has, I'll ask it 2 ways. First, the highest upside, you think?
The highest upside is outcome-based pricing if you can get it right, because it can scale to get such a large deal size in an account that you just like could never justify with a flat fee price where you're charging the same amount to every customer.
I'm guessing you're going to give me the same answer here, but which one has the highest risk, or like the floor could drop out here if we do it wrong?
Yeah, probably flat fee models, right? We talked about Red Lobster's endless shrimp for $20 and how that cost them tens of millions of dollars every time they ran it. But for a while, they tried to make it up on volume, which then just cost them more money. That comes up a lot with flat fee pricing.
I thought you were going to tell me outcome-based pricing, because like the whole like if we build it, they will come. Like, what if they don't show up? But you make an excellent point there that if you do flat fee and then they go to absolutely ham on the buffet, you can run yourself out of house and home.
Yeah, and in AI products in particular, which everyone seems to be launching or trying to launch, your top 10% of customers often account for 70 or 80% of your costs. And so if you don't have a mechanism for charging them more money, your best 10% of customers are your least profitable customers. Not a great way to build a business.
And I have to admit, we are looking at all of these in a vacuum. I do think that some of these look better than others if the economy is absolutely ripping.
Oh, yeah. I mean, usage-based remember the usage-based boom of like 2021 to 2022? When the economy was ripping, everyone loved usage-based models. And then in 2023, as people started to pull back on their spend, the first thing they did was optimize their AWS or their Snowflake bill. And so like the first thing that showed up was, oh shit, these usage-based models, they're not working out so well.
Dude, there was a quarter in 2021 where Snowflake had 172% net dollar retention.
Yeah, that came down real fast with the correction. But I also think with these usage-based models, the changes happen faster. And so people don't necessarily need to make a big contract change to change their pricing like next year. They just change how much they use the product. And so if you're a Snowflake or an AWS, you see the corrections faster, but then you also see the rebounds faster.
But I do think over the last 3 years, we've moved away from usage-based and more to commitment-based, which is a slight shift. And it's important for CFOs buying it because even if you don't use it, you've already committed to that amount. And it also impacts what you walk face first into on a renewal.
Yeah, I think of these as like usage-based subscription models where someone commits up front to a certain level of usage and spend. And then even if they don't consume any of it, they're on the hook to pay for it. And I think one of the challenges that folks run into is that sales reps tend to be compensated based on that deal size. And so they're compensated based on how much they get you to commit, not how much you end up using it. So a sales rep often loves that upfront commit, and the CS team doesn't necessarily love it.
My buddy Ethan Schechter, we were laughing about seat-based pricing models in 2020. He's like, I sold 120 seats to 3 guys in a garage. We all thought we were going to ring that bell. We all thought we were going public. 3-year ramping deal, baby. Nothing could ever disturb this.
Oh man, yeah, I've seen some pretty wild stuff with the incentives drive behavior so much on the sales side.
I mean, would you agree though that you can get greedy as a seller in all of these?
You can get greedy as a seller in all of these, but you get especially greedy when you're asking for an upfront commit ahead of usage. And when you have more flexibility where you have an ability to kind of set pricing where the customer doesn't have as much transparency into it. So like with a seat-based model, you're telling your customer how many seats they're buying. And like they can kind of call BS on that. Hey, we only have 10 people on the sales team. Why are you charging us for 50 seats, right? Like they can call BS on that pretty well. Or feature-based pricing, you only have so many features that you're packaging. So you could oversell the customer into a higher tier of your product, but like there's only so much you can gouge people. With usage-based models, your customer has no idea how much they're about to consume. And so you could put them in a tier that's like 10x what their usage will ever be.
Okay, this may be a stupid question. So the third person in the room, not Ben right now, is the payment terms on all of these. You've seen these outcome pricing models get deployed in action, Kyle. All the other ones we mentioned, most of them have an upfront payment to them, right? You don't have to look backwards. Are companies asking for you to commit and pay up front a certain amount for outcome-based pricing, or does that model kind of suck for cash flow?
So in true outcome-based pricing, the idea is like it's more of a post-pay model. So the customer agrees to what the pricing is going to be, but they actually have to see the outcomes before they're going to pay for it. So it's a little bit different in that way. Usage-based models could be pay-as-you-go, like could be tied to actual consumption, but they're a lot more likely to be commitment-based. It's a little harder to get the customer to pre-commit to outcome-based because outcome-based is kind of like unpredictability squared. You don't know how much the usage is going to be, and you don't know what the success rate is going to be. And so it's really hard to figure out like, what do you try to get the customer to commit to?
And that part is an unknown that I don't really like as a CFO if I'm the seller, because if things are going really well, you could technically grow yourself into the ground because you're waiting for people to pay you after the fact. So especially if you're an AI company, so you're using up more compute and they're not paying you until after the fact. And if there are 30 or 60-day payment terms, but like there are more and more users consuming, that could be quite the pickle.
You're delivering the service, you are paying the rep for selling the product oftentimes. Yeah. And yeah, you're not getting paid until way later. And then you're often chasing down those payments. In those kinds of businesses, even if the business actually is healthy on a fundamental level, cash flow can really be a different story.
But I mean, even my Snowflake contract, people are like, oh, that's usage-based or commitment-based, like we said before. I was paying up front for that each quarter. I got it down to quarterly terms rather than annual. But most companies pay up front. And then if you go over, then you pay again. So a lot of these usage-based models, cash is still up front.
Yeah, in the commitment model. So cash is still up front, but if you're a public company, the rev rec is more at like as consumption happens.
Yeah.
And so if you're a private company, you're just like celebrating the ARR and the upfront commitment. If you're a public company, you're a little bit more on the hook to actually make sure that the usage happens as well.
So we have an interview coming out tomorrow on Run the Numbers with Michael Sanders of Revenue Management Labs. And I know that you guys talked about value-based pricing. And one thing that I really enjoyed was there was a bit where you're talking about like, oh, this product saves me like $500,000 or something. You shouldn't then charge $500,000 for that thing, because then it's like, what are they getting then if you're charging that much?
It's an excellent point, Kyle, around splitting the value. And I think it's kind of permeates through all of these. I was listening to the interview with the CEO of Intercom on Lenny's podcast, and he was saying with outcome-based pricing, they knew that what Finn was doing was definitely worth maybe like $10 per ticket resolution, but instead they only charged one. It's like, how the hell do you decide how to split the baby there?
Well, and I think they actually got a little wrong. They underpriced initially. So for on-prem products that were sold like perpetual license, you buy it up front. Folks typically only get like 5% of the ROI the customers get, because customer is taking on a low risk. They're paying up front, so it's a capital expense. There's not the ability to capture much more than 5%. When we moved from on-prem to SaaS and subscription models, we were able to capture 10%, maybe 15% of the economic value. But with these outcome-based models where folks are only paying when they're successful and kind of paying after they're successful, I'm seeing cases where companies are getting 25 to 30% of the economic value. So the customer still has to get most of it, at least half, since there has to be something in it for them to buy this product, but the vendor can take on a lot more.
I was not an economics major, but like technically anything that's 1% better in value, you'd be willing to do. But then you have to factor in like the moving costs, switching costs, implementations, teaching people new things. But yeah, I've always wondered
in
how to
theory,
split it.
Yeah,
in
in
theory.
theory, like that 1%. But if you've ever done like game theory in economics, like you get punished if you're seen as gouging or being unfair. So people don't actually accept what might be economically rational. The other thing that happens is that buying your product is one decision, but there's so many other things the business could do that could be seen as higher ROI. So the decision to buy your product is not in a vacuum. It's in the context of every other initiative that company could do.
Oh, you know what I noticed isn't in here? Take rate pricing. Or maybe it's one of these just said a different way.
So take rate pricing, I focus on SaaS pricing, and I would think of
Yeah.
take rate as more marketplace, but that ends up looking a lot more like outcome-based models because you're really only taking a percentage of the transaction when a successful transaction happens. And so it's much more akin to outcome-based models than any of the other models on this list.
And that's honestly where I've seen the most value gouging because you feel like you're actually being penalized. So an example, like in the travel industry, if Booking.com was to raise it to like a 40% take rate, the hotel would be like, I'm actually losing money every time somebody stays here. So I don't know. I always find the marketplace pricing dynamics interesting too, in terms of who wears the pants in the relationship.
Well, that's where I think like that's what sets some of the tone for how much these outcome-based models can capture. And so if you're like a DoorDash, you might take 25% of the cut on a transaction, which is a lot of money to take for a restaurant that is a low margin business. But many of these marketplace models take a pretty high transaction share in terms of their take rate. And so we're starting to see that come towards SaaS products, which historically have taken a much lower share of the overall value.
You have to think what is your end customer's P&L. So we experienced that at PartsTech. I'm just making up numbers here, but let's say we made 1% on every transaction. That is actually much more to an AutoZone or Napa. It could actually represent 16% of their margin. You're like, oh, what's 1%? It's like, well, if they're only making, I don't know, 14, 15% of it, that's a pretty big deal.
I'll let you check out the math on that one.
All right, listen, I know when you're defending your castle, it's probably a good idea to have some sort of, like a trebuchet or maybe a catapult, but a moat, that's also a defensive mechanism. Is momentum a moat?
Medieval Ben, back again.
So I keep seeing this everywhere on like LinkedIn and Twitter. Are you seeing this, CJ? This like momentum is your moat thing?
It took over. I don't know what happened this weekend.
This is like saying like the moat for a rabbit against a wolf. It's just the rabbit's going to run faster.
Alex Immerman had a great corollary to this, I think, because it was his fellow investing partner who put this out at first. He said momentum is not a moat, but it is a boat. It gets you to the island where you can then create a moat. What I find funny in this whole conversation is that it's predicated on businesses that, from the investor's perspective, need to hit some escape velocity that is absolutely incredible. And so, yeah, in that sense, you do want momentum. You do want to move fast. You do want to scale very quickly and shut the door behind you so nobody else can climb up the ladder.
I mean, I guess, so the logic, it probably works something like this. If you have some momentum, you're able to direct funding, then with that funding, you can build more stuff. As you have momentum, you have a brand, you have word of mouth, you have customers. Your customers kind of tell you what to build to make your product more valuable, and you have more data than other people. And so then you can take the funding and the data to keep building that moat over time. Is that like roughly what these people are thinking?
Yeah, so back in 2017, there was this book. It was called The Formula by Albert Laszlo Barabasi. Can you believe I remembered that name? And so it was...
I cannot.
Yeah, I know. It was basically trying to create a formula with metrics to deconstruct what success is. What he was trying to look at is how do things basically... Is momentum a real thing? Can you quantify it? He had this concept of preferential attachment. And it's basically that when people spot you early on doing something good, other people want to be in on spotting you, like being the best at what you're doing. And it's like a snowball going down a hill. And it reminds me of a lot of these startups where they may not have even made any significant changes to their product, but they go out and raise another round and everybody's sharing it on LinkedIn because they want to show that, hey, I was somebody who spotted this first. It's kind of like when you hear a really good song and you share it with your friends so you can look cool in the process. And he explained in the book that there are a lot of people who in their careers just keep getting better and better opportunities because the first two breaks they got went really well. I'm sure it's the same thing with directors in Hollywood. They're not necessarily any more talented than somebody else, but because of preferential attachment, the opportunities just keep getting bigger and bigger and they just keep becoming more successful.
So I mean, I personally don't love this concept. Like momentum doesn't feel like a strong moat, but let's go with you. Let's say, hey, this is true. This is a real moat. How do you build momentum? When there's like a dozen teams that are going after the same opportunity that you see, what's the way to have this advantage around momentum?
Well, it's to pour copious amounts of capital in from investors. That's why I think investors are perpetuating this whole momentum argument. Like, it requires you to be extremely capital intensive and try to pull the future forward using those dollars by investing ahead of what you're actually making in revenue.
Charismatic founders that can tell a good story to get a ton of initial capital and just manufacture that momentum in some ways. And then for other folks, it is a 996 mentality of like outworking, although there's only so much more you can outwork a 996 competitor. Yeah. But then I came across, have you heard of this company, HeyGen?
I heard about it through you, I think a couple weeks ago.
So they're one of these AI native companies. They just said they hit 100 million in ARR. And the founder actually shared what they call their Bible for being AI native and for moving fast without breaking too many things.
What were the biggest takeaways? Well, actually, first, what does this company do again?
You could think of them as like an AI video company. So like AI avatars and the ability to make AI video for different kind of business use cases.
Okay, cool. And what were the takeaways from this Bible?
So, I mean, one of the things is just setting up teams that can ship really quickly. And so not necessarily having a 12, 18, 24-month product roadmap that goes stale really quickly, but it's kind of riding the waves of continued AI improvements. And so looking ahead to where AI is going, building teams that focus on, those product opportunities, but then really sprinting to be an early adopter or release really early as there are breakthrough capabilities in LLMs and the underlying technology.
I can't help but realizing that everything we're talking about here assumes that you're running a company as an asset, right? There's a difference between running a company to be sold at some point versus running a business to, just be in business and continue doing well for the sake of playing the game. And I think that's where momentum helps the most. If you're running an asset to try to get to escape velocity so you can eventually sell it and get returns for everybody.
Yeah, I think the underlying mentality is exactly that. It's not necessarily let's build a profitable, long-lasting business. It's let's be the one that gets to the next milestone. And that next milestone is probably another fundraising event. Yeah. And let's keep doing that until we have a real moat around our business.
Until we truly do have a moat. And just keep pulling the promise of tomorrow forward. And if we need to, we will sell erotica to make the balance sheet foot.
But one thing I found interesting about this, so Ramp is one of the companies that pre-AI, I think, was super proud of how fast they moved and were able to innovate in a space that had other players. I'm curious to get your take on this. Like, have you ever tried to increase the urgency or like get your team to move faster? And, what did you do to make that happen?
Yeah, I mean, I felt like that was my job. I was just like the person who's yelling at the rowers, like faster.
So your solution was just yell at the rowers?
My solution actually was to try to. So the hard part is you tell people to go faster, but they're like, why? And I think what you have to do is you have to equate back what their contributions are, what it means for them, and then what it means for the company. There are a lot of people out there who say like, oh, we have to get to 100 million this year, but you don't explain to the individual who's actually rowing the oars how they can directly impact that. And a lot of times it's only explained in a way that people can understand for the sales teams. Like, how do you explain to the engineer that like, dude, you're actually contributing to a product that'll make $50 million this year? How do you explain to the HR person that they're filling the capacity for the sales team to achieve their quotas? And so I think you have to make it real at the individual level.
Yeah, I think that's a good point. I also would say there's a big role for goal setting and having more frequent goals. So like instead of annual goals, for example, quarterly goals or maybe monthly goals, and always making those goals a little bit uncomfortable where everyone's like, I guess we could maybe hit that, but it's going to be really hard. Like to have different goals for the team versus like what you communicate to investors, which are maybe a little bit less aggressive, but have the team be a little bit uncomfortable for what they're signing up for, knowing that that's sort of a stretch goal.
Yeah, it can go the other way though too. Like if you tell a CMO, I'm increasing your budget by 5% next year, but I'm increasing your pipeline target by 35%, that can actually be pretty discouraging and damaging to morale. But yeah, I know what you mean. You have to set it at a point that feels like a stretch, but still like humanly possible.
Let's unpack that. If you say we got to increase your pipeline goals by 35%, but only increasing spend by 5%, you could instead say for next quarter, we want you to increase pipeline by 10% and we'll increase your spend by 2 or 3%, right? And then the quarter after, it's another 10%, right? The quarter after, it's another 10%. So the shorter you make those milestones, I think that you can actually ratchet up that urgency without it feeling too discouraging.
Yeah, yeah. I mean, I've also seen it with OKRs where you set something so aggressively that by the third quarter, the OKR just does like this Irish goodbye off the slide where suddenly it's just not there anymore because everyone's like, we are not going to hit that. And that's where you don't want to lose the room of trying to get people to rally around something, but setting it so high that they're like, you know what, it's a lost cause. Let's pack it in for next year.
Yeah, if people think that they're not going to get any sort of like bonus or their equity is worth nothing, that's the kiss of death. But the other thing that comes to mind for me is that it's always helpful to have that one person in a meeting or on the team who's a little bit of an asshole. In that, like you have a meeting, you're talking about next steps and when someone's going to be able to get something done. The team's like, oh, we'll deliver this end of next week, and you have someone go, well, could you get this done this week? Or hey, why can't you ship this tomorrow? Having that person that pushes on deadlines, it just consistently across the team. No, that person also has to model the behavior themselves, but kind of need people like that to hold everyone else accountable.
Call the CFO.
Next up, we've got one of my favorite segments. It's business blunders, folks. Take it away.
CJ, have you looked at your LinkedIn stats lately?
I look like a couple times a week. Sometimes I'm happy. Sometimes I'm sad. I'm probably sad more often than happy, though.
So I was initially really happy because I looked at my stats of like follower growth and it was going through the roof. And then I noticed that LinkedIn changed their default setting. Instead of telling you like how many followers you're adding per day, they now tell you the cumulative number. So it like only looks like it goes up. And I was feeling real good about myself until I realized it's a flatlining curve.
Wee, wee, wee. Oh, look, it's the Y-axis police back again. This is gross. Also, welcome back to the show where we describe charts using words rather than images. People are loving it. This is a cumulative metric crime of mass proportions, Kyle.
It really is, but it had me feeling so good. I mean, if I'm LinkedIn, I totally understand why they share this.
Is that real, Kyle? Or is that Ben's numbers there? That huge uptick there?
These are Ben's numbers, but
Ben. Wow. That must have been a strong post, my friend.
We had to get Ben to promote the podcast.
Kyle, is there anything that we should change with how we're posting based on this, or it's just a measurement thing?
It's just a measurement thing. I just thought it was like notable when I checked my stats. I thought people might get a kick out of that.
Trust but verify. All right, Ben, what do we got next?
You guys must be having some sleepless nights because it's time for the potentially reliable thing that you read at 2 a.m.
All right, CJ. Earlier we talked about title deflation and the Bonfire, the middle managers. One of the things that I read about was managers and direct reports. So what do you think is the optimal number of direct reports, like on a scientific basis?
I think it depends on the department, but I'll generalize here for the sake of the combo. I bet it's 8.
Bet it's 8. Well, you're not that far off from like the rule of thumb. For a while, everyone just like came to believe 6 was the right number. And it turns out the origin story of that is like a mining engineer out of Australia wrote, an initial management book where he said 6 is the optimal number. And now people just think 6 across every company and industry. An HBS professor has been studying this and refreshing the metrics. And they're now saying the optimal number of direct reports is somewhere between 12 and 15. The NVIDIA CEO actually says he has more than 50 direct reports.
So that's wild because he's actually closer to the Dunbar effect. Do you know what the Dunbar number is, Kyle?
I have no idea.
So it's the concept that in smaller communities, like before the Industrial Revolution, communities would be closest if it was 150 people or less because you knew everybody by name. And so it carried over to startups as well. And I can actually agree with this to a certain extent. Like, I think that after 100, 150 people, you stop being able to know everybody by name, at least if you look at them on a spreadsheet, and it feels like a much bigger company and less of a community. So when you started to go on to that riff on the ideal number, I thought it would have been something more around psychology, unless just like one guy said, hey, it's 6. And hey, that's an example of preferential attachment. Just stayed.
I mean, honestly, most of the business advice out there, I just am now thinking what's the origin of that is in the back of your mind is, what's ideal. And so much of it probably comes from these sources that have nothing to do with the world we live in today. And, I think if I am a mining engineer, I probably don't want that many direct reports because they could have a mistake that is pretty catastrophic. If you're like building a software company, it's kind of a different story.
Wait, so you said Jensen has 50 direct reports?
50, yeah.
Do you think he does 50 one-on-ones a week?
Oh, no way. He probably has his AI avatar do them.
Yeah, he needs a middle manager.
Next up, not the fake world, not the real world. Yes, the real world, not the show. It's pricing in the real world.
All right, so growing up, I wanted to be an author. I wanted to write the next great American novel. Now I send people emails about numbers. And I'm glad I do that because it's a much better business model.
Very valuable job for society.
Yeah, thank you. All jokes aside, though, the book of being an author and writing books, it sucks. Am I on this podcast alone? Is anybody there?
Yeah, sure does.
See, CJ, I think it's one of those things. I got pitched for a book deal recently, and I had this experience. I think if you are writing online for enough time, someone is going to pitch you a book deal. But it is an absolute scam.
It's a total scam. And I looked into how much you can make from a book deal, but also like what are the rules of the road here? And so everybody's probably seen in the movies, like it's an author who has writer's block, whatever, and they get an advance on their book deal, right? I think this was not Matthew McConaughey. Who's the other dreamy guy? Who you take the pill and you're suddenly smart?
Bradley Cooper. Bradley Boopler.
What movie is that? Infinite?
Limitless.
All right. Well, please, editor, make me sound smart there. So if you remember Bradley Cooper in Limitless, he has writer's block. He's already accepted the advance in his deal. And they're like, where's the book? Where's the book? Where's the book? And I'm like, wow, it must be awesome to be an author. They just write you a check for a whack of cash. And you and then you get more when the book sells. But how it's actually broken up is 1/3, 1/3, 1/3. So you get 1/3 of the advance when you sign. Then you have to write the whole book. And when it goes to editing, you get another 1/3. And then you get the final 1/3 when it's published. And sometimes they even break it into 4 milestones. And so the number in dollars that you get is usually less than 50,000. And then how it works is you have to earn back that advance, right? So you have a royalty number and it's usually under 15% of each book that's sold. So if you sell a book for $10, then you get $1.50, and that has to earn back the amount that you were advanced. And then after that, you share in the royalties. But the vast majority, more than 80% of authors, never even make it to the royalty point where they start making dollars. So most of the time, what your advance was is actually what you get paid overall. And not only is it a low number, but it's broken up into these installments that may span 2 or 3 years.
See, I think this $50,000 number is a misnomer. Most business authors, they're not getting $50,000 in an advance. They're getting like $10,000, maybe $15,000, of which, as you said, this all has to get earned out if they want to be paid anything beyond that. And the wildest thing for me in the business publishing world is that you as a author need to commit to selling 10,000 copies in the first year. You're essentially paying off your advance, and you are on the hook for doing the marketing yourself. They're not doing a whole lot of marketing for you. So they want you to do things like force any of your consulting clients to buy the book for all the employees of the company, bundle the book into any paid speaking gigs. So you're essentially doing all the marketing yourself to get back 15 cents on the dollar.
That's nuts.
I think we should just be newsletter writers, huh, CJ?
I mean, there are some people out there who write newsletters that make more for one post than somebody who's put their entire life into a book. So that's just how you know that the system is rigged there.
Mostly Growth is a Mostly Media production. Executive produced by Ben Hillman. That's me. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of CJ, Kyle, and Ben. Just some guys who love talking growth. Mostly. If you like this podcast, hit subscribe. Give us 5 stars or hit like. The algorithm overlords thank you. Drink water, call your mom, and have a great day.